The bull market is not old or tired. In last month's Market Reflections update, we argued that the equity rally was durable and that the reporting season would not be the catalyst to derail the rally. A month on, and despite a highly volatile reporting season, the ASX 200 finished up another 3%, which all things considered was a very credible result. While many refer to April 2025 as the start date for the current bull market, it actually began in March 2020, post the COVID sell-off. The ASX 200 is now up around 100% from this date, and at first glance that might appear a lot, but when viewed in the context of historical bull markets, the rally is neither large nor is it old. For many investors, the 22% bounce since April might already appear extreme, given it started during a period of very elevated economic uncertainty, high inflation, uncomfortably high valuations, and a lot of hype around AI. But if you've been listening to our messaging, you'll know that we don't agree, and we think the bull market remains intact and has significant upside in both duration and magnitude. In fact, we would not be surprised if it continues for the next few years, with equities posting above average returns during this phase. We know we've been more bullish than the consensus, but we've maintained this view throughout the year, and markets have rewarded us with a very strong bounce back. When on the cusp of lower policy rates and a cyclical upswing, equity markets tend to do well, and there's nothing about the current bull market that makes us think it's about to die of old age or extreme levels of euphoria. Since the market lows in April, we've maintained a positive view on equities, willing to buy the dips and look through the risks. We're now entering a seasonally weak period for equity markets, and this does raise the risks for a tactical correction. But looking further ahead, we think the bull market is alive and markets are not being complacent, but rather looking towards an improving cyclical backdrop with the added benefit of structural gains coming from AI, which for now investors are still unsure of how to quantify and evaluate. We expect the ASX 200 to continue rising, led by a rotation into cyclicals, small and mid caps, and rate sensitive segments, while moving out of defensive growth leadership, including banks. We think this will mark the start of a more balanced and valuation aware upswing, supported by four major tailwinds. First, policy rate cuts, where the Fed and RBA will continue to lower rates well into 2026. Second, an improving earnings outlook supported by margin expansion. While there is some debate on the level, there is no debate on the direction. We think profit leverage will surprise on the upside, just like it does in every cyclical upswing. Third, an improving global backdrop which supports risk-taking behaviour. While the near-term outlook is for some softness, this is well recognised by the market. We think rate cuts will allow investors to look through this soft patch, with global equity flows continuing to favour risk assets. And finally, changing equity market leadership. Market momentum is shifting from large cap defensives towards small and mid caps, and lagging sectors such as industrials, energy and financials, including platforms, fund managers and insurance. We see strong prospects for domestic cyclicals and interest rate sensitive areas to do a lot of the heavy lifting for the market as we move forward. September has historically been the weakest month for equity markets, with the S&P 500 averaging a 1% decline over the past 100 years. This seasonal weakness is often attributable to a combination of factors, including the return of institutional investors from their Northern Hemisphere summer break, increased trading volumes, and portfolio rebalancing ahead of fiscal September year-end. But alongside these factors, investor psychology also plays a role, as negative expectations can become self-fulfilling, exactly why we're talking about this phenomenon as we start the September month. After an almost uninterrupted rally since April, investors are becoming very wary of the rally, particularly given ongoing macroeconomic pressures, mixed data on the inflation front, uneven corporate earnings, and pockets of valuation excess. In addition, a lot of the outlook hinges on what the Fed will do and the future path of US policy rates, which are highly uncertain as we move closer to the Fed's September rate decision. While the September effect is well documented, it does not mean that every September will be bearish. However, awareness of historical patterns and an understanding of contributing factors can help investors mitigate this risk. Some practical strategies include remaining diversified across and within asset classes, being nimble and prepared to adjust if conditions change, and ensuring that portfolios have adequate liquidity should downside risks emerge. While there's no guarantee that September will be negative, the risks are sufficiently documented and that prudent investors should approach this month with heightened vigilance.